Canada's merchandise trade deficit widening in August to more than $6.3 billion. Part of that was a drop in exports, not only to the US, but also to the rest of the world. Declining gold sales were part of it. We're joined by Garnet Anderson, head of portfolio management at Tacita Capital. It's great to see you. Thanks very much. I know you probably don't spend that much time on export-import numbers, but what is your feeling about the economy right now?
Well, they do feed into the economy. I mean, you kind of look at goods exports, 60 billion, service exports, call it 20 billion. So it's pretty significant to the Canadian economy, and obviously stateside. That's a big part of the relationship. A little visit going on today with our Prime Minister and President stateside. So we'll see how that goes. So it was a little bit of a wider number than a consensus, actually more than a wider number. We did see a little bit of a retrenchment or improvement in the revision for last month. So that was a little bit of a positive. At the end of the day, you're seeing the effect of the tariffs ripple through. So are the U.S. going to put tariffs on gold bars or not? That caused a lot of concern. Going back, so we saw in August, we saw the flows down to the state exchange. We saw the flows from Switzerland and South Africa change. That was whipping around those numbers. But when you look beyond that, you've kind of got, well, forestry is down. Well, tariffs. Metals are down. Tariffs. A little surprised to see machinery down going to the States. We thought with the big buildup of the industrial complex down there that maybe that wouldn't have been as affected as much. But we also see like nuclear out to Japan, nuclear fuel, that came off. So it was a little bit of a dynamic month for trade. Now it's August, and the challenge will be, will we get September numbers in time for the next, Bank of Canada? Because StatsCan uses basically U.S. border counts, if you will, to drive some of our trade down to the States. Will we have a release for September numbers on time? It will be interesting. So a little bit of a lag there, and just puts a little bit more pressure on the Bank of Canada. Do they get, quarter point cut already? Do they take that next step? Because it's a little foggy out there, and it's apparent that tariffs are starting to chip away a little bit at our international competitiveness.
What is your feeling about the Canadian economy? Are you avoiding, companies that might be dependent on a strong consumer, for example?
I think mindful of that. There's certain, but it's interesting when you take a look at foot traffic, or you take a look at, those kind of very consumer discretionary stocks. They've actually fared quite well. The Canadian consumers continue to spend for the most part. There's certainly areas, Windsor and whatever, that have been disproportionately affected. But overall, the Canadian economy has proven to be more resilient, certainly much more so than what we thought back in the spring.
Right.
I mean, that was a whole different ball of wax.
Yes.
Having said that, our unemployment rate up at 7.1, 7.2. You have to be anxious about that. And that's why, again, I think it comes back to the Bank of Canada will have some pressure on it. And not that it can be benign toward the inflationary outlook. We haven't quite solved that, but it's been a little bit stubborn, but trending a little bit in the right way. But that could button hook in a heartbeat.
I'm just looking at Canadian Tire. I always think that's a pretty good
barometer
benchmark for Canadian consumers. The stock, maybe we can put up a one-year chart for CTC.A. Stock is still up about 13% this year.
Well, yeah. Now contrast that to the TSX Composite. That's up 20% plus, right?
Yes.
So it has lagged. But again, you also part of Canadian Tire. If you don't have people selling and moving condos and houses, there's fewer walls to fix, walls to paint, and hooks to put in. And so there's a little bit of a spillover effect there, I think.
It is partly a housing stock, as you know.
But it is seen a little bit as defensive, similar as Loblaws.
Interesting with Loblaws. Maybe we can put up a one-year or a five-year chart for Loblaws. It has come off its record highs, Loblaw, but not by much.
No, not by much. I mean, we all go to the grocery store.
Right.
And we all raise our eyebrows. And you do start to wonder about, their ability to continue to push through prices. And that's got to crimp at some point. But I think if you looked at most of the grocery stores you walk into, they are really trying to attack their cost structure. If there's 13 checkouts, 2, 3, 4 maybe staffed, pushing more people through the automated check yourself out corral, if you will. So they're trying to deal with that as well. But that certainly has put Canadians on their back heel in terms of their spending power.
I am one of those people who, if there's a line about the cash, I'm out of there. I'm leaving the stuff on the shelf. I'm out of there. Yeah. I mean, they can put in automated checkouts or something, I think.
Well, absolutely. Again, because, I mean, they are facing price pressure. And we saw that through the latest Canadian PMI. Those input good prices are still rising. And so that brings margin compression. Now, mind you, when you take a look in the stock market, why is the stock market up? Corporate earnings have been very strong, and in part due, lower taxes, lower interest rates, lower, energy costs, what have you. But their margins just continue to click higher. And people will say, well, that's also investment in technology, AI, and so on and so forth.
You have some ideas for us, including 2 gold stocks you'd like to look at, Wheaton Precious Metals and Barrick Mining. Why those 2 in particular?
Well, I think because they create a balance. Let's pull back just for a second if we could. Bullion is bullion. That would be the base portfolio implementation. That's where you get your greatest diversifier in a portfolio. But everybody's all excited about gold. You just pointed to a chart, over 4,000. How can you not get excited? You take a look at the top 25 performers in the TSX composite. 20 are metals and mining companies, and 1 Sprott.
Okay, so quasi-mining, yeah.
So give them an honorary inclusion there. So 21 or 25. And they've ripped ahead. If gold's up 50%, silver's up 65%, the gold index is up, 120, 130%. Chase, so you can see it's like a wave. Bullion, seniors, juniors, as they all start to get their operating and financial leverage clicking in with the higher price of gold. When you've had such an extended run, though, we would think twice, about dumping your bullion exposure. It can't go on forever. You don't want it to turn into a round trip. But perhaps there's some more legs to the gold trade. But if you're just coming into a trade now to jump into the juniors and try to pick 1 or 2 that have a single mine or a JV in a particular mine in some country that politically, isn't very secure, that's perhaps not the way to play it. That's what we back up to in terms of you've got Barrick, which is an age-old Canadian mainstay. They're continuing to retool their portfolio. They had challenges in their Mali, where the government came and took over. They've been selling off some other, Alaska and Canadian mines, raise cash, up their share buybacks, and really focus in on their top shelf projects. And we like that long-term profile. And then whereas you've got Wheaton, which is more of a kind of a streaming royalty type of company, they go in, they put the capital in, they lock in at low prices, and then they're able to sell that into the marketplace at nice spreads. And so they've both been on a run. Wheaton had been taken off. We've been on market darling for years. Oh, yeah. Barrick less so, but when you take a look at the last 6 months, Barrick has kind of made up for lost time, and Wheaton's a little bit plateaued. So it might be an opportunity, for example, if the U.S. government goes back to work, and maybe there's a 5 or 6% sell-off in gold, that might be a decent, long-term entry point for those 2 plays.
It's interesting. ZJG, a BMO ETF that tracks the junior golds, is up 130% this year.
It's again, that's where the TSX component's coming from. And most Canadians, think before they jump into the pool, look at what you already own. It's already 17% of the TSX composite. If you've got momentum strategies in your portfolio, it's a good component of your momentum strategies. In the States, it's all AI. Here, it's all gold. So just be aware of what you own before you kind of leap.
Garnet, thanks very much.
Thank you.
Garnet Anderson, Head of Portfolio Manager at Tacita Capital.